Hey traders, Joseph Mwara here, and welcome to this deep dive into multi-time frame analysis for consistent Forex profits. Let's be real for a second. Trading without a proven edge is like navigating a maze blindfolded, frustrating and definitely not profitable. That's why today we're ripping off the blindfold and handing you a powerful roadmap to navigate the Forex markets like a pro. We're talking about mastering multi-time frame analysis, a strategy that separates consistently profitable traders from the rest of the pack. Forget about chasing random signals or relying on luck. This is about understanding the DNA of the market and making high probability trading decisions. All right, let's get this show on the road. The first step to multi-time frame mastery is identifying the primary trend. We'll use the 4-hour chart for this. It gives us enough clarity without getting bogged down in the noise of lower time frames. Now slap on the 50-period exponential moving average, EMA, and the 200-period simple moving average, SMA. Remember, the 50 EMA is our fast moving average, while the 200 SMA acts as our trend filter. When the 50 EMA is cruising above the 200 SMA, we're in an uptrend. Conversely, when it's below, it's a downtrend. Simple, right? But hold your horses. Before jumping into any trades, we need to make sure the trend is strong. This is where the average directional index, ADX, comes in. We're looking for an ADX reading above 25 for confirmation. And don't forget to zoom out and check the daily and weekly charts for any major trend conflicts. Trust me, aligning your trades with the higher time frame trend is like having the wind at your back. Now that we've established our directional bias, it's time to zoom in and pinpoint those high probability entry points. We'll shift our focus to the 15-minute chart for this. Remember, trading is a game of patience. We don't want to jump the gun. Instead, we'll wait patiently for pullbacks to the 21-period EMA. This moving average will act as our dynamic support in an uptrend and resistance in a downtrend. But here's the kicker. We don't want to rely on just one indicator. That's like trying to build a house on a single pillar. We need more confirmation. Look for bullish candlestick patterns like hammers, bullish engulfing, or morning stars near the 21 EMA for long entries. Conversely, look for bearish patterns like shooting stars, bearish engulfing, or evening stars for short entries. And don't forget about volume. Increasing volume on these pullbacks tells us that other traders are jumping on board, increasing the probability of our trade working out in our favor. Now let's talk about exits. The often neglected aspect of trading that can make or break your profitability. Remember, knowing when to get out of a trade is just as crucial as knowing when to get in. One of my favorite tools for setting precise exits is the average true range, ATR. This nifty indicator helps us determine the average volatility of the instrument we're trading and set realistic take-profit targets. For instance, if the ATR on the 15-minute chart is 10 pips, we can aim for a profit target of 20 to 30 pips, giving our trade enough room to breathe. But here's the thing. Markets are dynamic and we need to adapt. That's why we'll implement a trailing stop-loss strategy. As our trade moves in our favor, we'll trail our stop-loss behind the 21 EMA, locking in profits and protecting ourselves from sudden reversals. And if you want to sleep even better at night, consider taking partial profits along the way. This way, even if the market reverses, you've secured some gains. Let's talk about risk management, the cornerstone of any successful trading strategy. Think of risk management as your financial seatbelt in the fast-paced world of Forex trading. It's not the most exciting part, but it's what will keep you in the game for the long haul. The golden rule? Never risk more than 1 to 2% of your trading capital on a single trade. This means if you have a $10,000 account, your maximum risk per trade should be $100 to $200. This way, even a string of losses won't wipe you out. Next up, maintain a healthy risk-to-reward ratio of at least 1 to 2 for every trade you take. This means if you're risking $100 on a trade, you should aim for a potential profit of $200 or more. Why? Because even if you win only 50% of your trades with this risk-to-reward ratio, you'll still be profitable in the long run. Finally, always, and I mean always, place your stop-loss orders below recent swing lows for long trades and above recent swing highs for short trades. You can also use a multiple of the ATR for a more technical approach. Remember, a well-placed stop-loss order acts like your emergency brake, automatically limiting your losses if the trade goes against you. Now let's talk about timing the markets, because when you trade can be just as important as what you trade. Remember, the Forex market isn't a 24/7 all-you-can-trade buffer. It has its peak hours where liquidity and volatility are high, creating ideal trading conditions. One of the best times to trade is during the London and New York session overlaps. This is when trading volume surges, leading to bigger moves and better opportunities to capitalize on your multi-timeframe analysis. However, timing isn't just about sessions, it's also about being aware of major news events. Avoid trading around high-impact news releases like interest rate decisions, central bank speeches, or major economic reports. Why? Because these events can trigger extreme volatility, often rendering your technical analysis useless. Remember, even the best trading strategy needs the right market conditions to thrive. Let's talk about the most crucial element of trading success: mastering your trading psychology. Because here's the thing, trading is more of a mental game than anything else. It's about managing your emotions, staying disciplined, and not letting those pesky psychological biases cloud your judgment. The first step is simple. Stick to your trading plan. Treat it like your trading constitution, your guiding document in the heat of battle. Don't let emotions like fear or greed lead you astray from your predefined entry, exit, and risk management rules. Next up, keep a trading journal like it's your trading diary. Record your trades, the reasons behind them, what went right, what went wrong, and what you learned. This will help you identify patterns, understand your strengths and weaknesses, and make better trading decisions in the future. Let's talk about backtesting, the secret sauce to refining your trading strategy and gaining the confidence to pull the trigger. Think of backtesting as taking your trading strategy for a test drive before hitting the live markets. It's about going back in time and seeing how your strategy would have performed historically, giving you valuable insights into its strengths and weaknesses. Start by choosing a platform or software that allows you to backtest your strategy. Then select a specific period and currency pair that aligns with your trading style and goals. Input the rules of your multi-timeframe strategy, including your entry and exit criteria, risk management rules, and any other parameters you deem important. Once you've run your backtest, analyze the results carefully. Look at metrics like win rate, risk-to-reward ratio, maximum drawdown, and average profit per trade to assess the effectiveness of your strategy. Remember, backtesting isn't about finding the holy grail of trading strategies. It's about understanding how your strategy performs under different market conditions. Choosing the right Forex broker can make or break your trading success. Look for a broker with a solid reputation, tight spreads, low commissions, fast execution speeds, and excellent customer support. Remember, your broker is your gateway to the Forex market, so choose wisely. Once you've got your broker sorted, it's time to set up your charts like a pro. Use a charting platform that offers a wide range of technical indicators, drawing tools, and customizable features. Personally, I prefer using a clean and clutter-free chart layout with only the essential indicators I need for my multi-timeframe analysis. Finally, remember that consistency is key to success in trading. Establish a regular trading routine that works for you. This might involve analyzing the markets at a specific time each day, reviewing your trading journal, or practicing your trading strategy on a demo account. So there you have it, a comprehensive guide to mastering multi-timeframe analysis for consistent Forex profits. Remember, this isn't a get-rich-quick scheme, it's a skill that takes time, effort, and dedication to master. But trust me, the rewards are well worth the journey. If you found this guide helpful, don't forget to like, subscribe, and hit the notification bell for more trading tips and strategies. Share it with your fellow traders, and let's build a community of consistently profitable traders.